Yeah, I really appreciate being invited to this. If we can go to slide 38. And just hats off to Shaw and Partners for taking us public 3 days ago, raising $35 million of capital to really fund the growth of the business, as well as we just put out our Q3 trading update. And the first time since our inception, we actually drove EBITDA profitability for Q3. So look, I'm going to spend a little bit of time here giving you an overview of the problem, how we're addressing it, and the uniqueness of our business model. But I'm happy to answer, any questions. So let me take a step back. Look, there's a huge structural problem here in the United States that a lot of you may or may not be familiar with. We have over 120 million credit challenged consumers, which is about 47% of the entire adult population in the US, that are fundamentally shut out of mainstream credit. They don't get a credit card with open to buy at 0 to 18% interest. They don't qualify for the latest buy now, pay later alternatives through Afterpay, Affirm, Sezzle, QuadPay, Klarna, all the rest of it. They're typically relegated to three basic industries to finance product. And it's been the same way for 30 years, where you have a massive population in the US that is really trapped by a cycle of debt. So we have three industries here: rent to own, lease to own, and of course the payday lending industry, where consumers can either get a slim selection of goods and services where they pay 200 to 400% above retail for basically used product, or they take out a 400% APR payday loan to go out and buy what they need and really get trapped with the interest, fees, and penalties that accrue from that. Which in 2019 was over $66 billion of interest, fees, and penalties associated just with these three industries alone. So look, there's an $85 billion market opportunity to disrupt all these legacy alternatives, level the credit playing field for these credit challenged consumers, and give them an ability to buy what they need and pay over a substantive term, because none of them can really afford to use one of these four payment models. So as Tim said, Zebit is a California-based e-commerce company with our own buy now, pay later alternative, where we offer the ability for credit challenged consumers to buy what they need across 25 different product verticals and pay back over 6 months without interest, fees, or penalties, or pulling here in the United States called a FICO score. And so this is a white hat offering that is transforming the way consumers in the United States get access to product and credit. Now, I founded the company in 2015. We went into production in 2016. We raised, before the IPO, about $55 million of venture capital out of Silicon Valley. We've had compounded annual growth since 2017 through 19, over 100% year over year, given the capital that we've raised to prove this fundamentally different business model. This is not a better mousetrap. There is no one data source to really understand how to allocate credit to a credit challenged consumer in the United States. We've had to build our own, and I'll talk a little bit about that in a second. In the prospectus, as you can see, and all the financial information is in there, we're targeting for our forecast period to be about $109 million. This is all US. Going into next year, the forecast period has the first half of next year in it. We're back post-COVID, returning to almost 100% year-over-year growth again. And we plan to use the 35 million Australian to really fund acquisition to scale the business to profitability over the next 18 to 24 months. Next slide. So let's just talk about some key highlights. Look, it's a massive market and there is no competition. There's nobody in the United States, no e-commerce company, not Amazon, not Target, not Walmart, that has figured out how to crack the signal to give credit to people that don't have what we call a good credit score. And there's 45 million people in the US that have no credit score, and the rest of them have an impaired credit score. Zebit has cracked that signal. We have 5 years of operating experience, really building our own big data set, all the stuff that Martin talked about gathering your own consumer behavior data. Well, we've wrapped all of that and invested about $55 million over the last 5 years to build our own big data set, to have machine learning models that underwrite a customer at the point where we acquire them and at the point of sale. And I'll make this clear through the customer journey. Look, we are an e-commerce company. We capture the full gross margin of the transaction. So unlike some of the other buy now, pay later players that get 2 to 3% of commission off of the total transaction value, because they sit in some other e-tailer's cart. We own the transaction, we own the customer, we own the credit loss. And the way in which we keep the vast majority of our gross margin is to ensure we have a streamlined e-commerce operating model. And so Zebit is connected with some of the largest wholesalers, distributors, and manufacturers in the country to offer 25 different product categories at any one time, 90 to 100,000 SKUs across these categories to our consumer base, where they can buy now and pay over 6 months. Now, we have really have a special advantage, not only in our underwriting, but really in the customer is the asset here. So we acquire a customer for less than $12. We pay it back in less than 12 months, which here in the United States, that's the gold standard for payback. You pay back the marketing and the fully loaded data cost to acquire this customer. Okay? This customer buys and buys again and again and again. So we've created a one-stop shop for this customer where they're consolidating their purchases and really de-risking their own revenue over time. And I'll get to that in a second. I think a really important part to looking at sort of a 5-year business is the customer also rewards us, not only with their purchases and their payback, but also they refer new registrants to us for free. So about 24% of our monthly registered users come to us free of charge. And that's what really keeps our acquisition costs low. Why do they do that? Because really over the last 30 years, this customer base has never gotten a fair value proposition that gives them the ability to buy like a first-class citizen, pay back over time, and not really be the prey of interest fees and penalties. On the upper right-hand side of the corner, this is an example of sort of customer revenue that builds over time, and I call this subscription-like revenue, even though there's no fee to join. You take, for example, when we started the company in 2016, the customers that we acquired in November and December generated $2.4 million of revenue. Those same customers generated $3.6 million of revenue in 2017. Customers generated $2.7 million in 18 and 2.2 in 19. It's not that all the customers remained in the cadre, because we had good attrition, obviously we had some credit losses, but because these customers have bought and shop responsibly and pay back on time every time, they're actually growing their lines and they're contributing to a material part of the revenue year after year. So fundamentally, our competitive advantage is how we underwrite customers using our data, third-party data, the 4 million applications, the millions of orders and order attempts that have happened on our platform. But we also get the benefit structurally that as a customer pays off their first order over 6 months, their bad debt just drops exponentially. And as you're on the platform for a year, 2 years, 3 years, we have proven that we've transformed this risky customer into a customer that looks like you or me, that really has expected bad debt in the 1% to 3% range. Next slide. So let's talk a little bit about our business model. So we are an e-commerce company. We have our own buy now, pay later solution. We offer products and services from electronics, home, jewelry, fragrance, outdoor. We're the only company in the country, in the United States, that actually can finance virtual electronic certificates. So I can actually finance if somebody wants to do an oil change, take a vacation, go on an airline, or buy something that I don't offer at this point in time. We have over 81 different dropship suppliers on our platform. And that really allows us to avoid all the gross margin eating activities. We don't buy inventory in advance. We don't have warehouses. We don't have the concept of discounting. We don't have the concept of returns. And all of that eats at the gross margin of a typical e-commerce company. All of it is just in time. It's all technology enabled, integrated with our suppliers. We've just hit the tip of the iceberg, in the US to really build out our product portfolio. Next slide. So let me talk a little bit on the left-hand side. How do we acquire customers? Because we're talking about a massive market in the United States. We have 3 basic channels. The first channel I talked to you about was organic, which is absolutely free acquisition. We have what's called a Net Promoter Score, the willingness to recommend, which is world-class relative to Netflix, USAA, Amazon, etc. But it doesn't really mean anything unless somebody actually drives somebody to your site and you approve them. And as I said, almost a quarter of our monthly acquisition every month for the last 3 years comes free of charge because we're offering something that no other company has ever done to break the cycle of debt, to this audience. We also have B2B partnerships and platforms. So we're integrated with the largest benefit platforms in the United States. A benefit platform is a platform that would offer payroll and HR and healthcare, et cetera, to a small and medium-sized business all the way up to Walmart, Amazon, Citibank, and Wells Fargo. And so we're integrated to some of the largest benefit platforms. They have buy now, pay later that's carved out on the site with our product feeds. And if one of their employees clicks and comes to our site, we pay them a fixed dollar fee. So I don't pay for traffic. I only pay if I decide to cherry pick, if I decide to underwrite that customer and give them access to the Zebit market. On the B2C front, we also do direct-to-consumer marketing, Facebook, Taboola, Twitter, paid search, etc. Customers come through, everything's done online. You can register in about 90 seconds to 2 minutes. We have machine learning models in their third generation, looking at everything at the point of registration. Are you who you say you are? 1 out of every 2 people in the United States, their credentials have been breached. So you have to be very good at identifying, are you the person that is applying? We assess their identity, their employment, their income. Can they afford what we're about to give them? And then we have another model that allocates store credit so they can shop in our market. Now, our market is absolutely closed. You can't get in unless you're registered, okay, and unless you're approved. And this is where I think we're the only company in the world that does real-time underwriting at the point of sale for a credit-challenged consumer. And this has been my experience for the last 10 years in fintech and the last 15 years in e-commerce. So as you're going through our site, we're collecting all of that consumer behavior and modeling it for the incremental order risk to basically decide, do I ship that order or not? And there's differential risk for a new customer that's been on the platform but haven't paid off an order, but might have ordered multiple times, or a customer that's been with us for 4 years, but might show a little bit of instability in their latest payment cycle. The models are segmented to look at differential risk in order to approve an order or not. If the models approve it, it's a very similar e-commerce transaction. The order gets shipped, it gets dropped to our supplier, the supplier ships it out, that's their obligation. We set up the installment payment. Every customer pays something at checkout, and then we finance, for example, if a customer pays 25% of their cart total at checkout, we'll finance the 75% over 6 months in equal installments according to when they get paid, because we understand where their income is coming in or where they're employed. If somebody does not pay us, the system automatically turns them off. And if they cure, they get their line back so they can shop. So there are no penalties, there are no late fees. We don't make any money from interest or asking people to defer their payment, which is becoming another popular mechanism again. But we don't do any of that. Next slide. So one of the other things about, and this is a lot to digest, and we could talk for hours about this, but one of the other things to really talk about our business is we financially engineered the cash flows of this business to be extremely efficient, okay? And so we're not just using equity capital to fund all these orders, but we actually have a debt facility in the middle where we have a 90% advance rate off of COGS. But the way it works is, let's take an example $1,000 order, an example 25% gross margin, even though our gross margins are up to 27.5%, 28%. A customer, let's say, pays 25% at checkout. So we get $250 right there. We have terms with every single one of our suppliers. So the average term, we don't pay our suppliers for 30 to 40 days. So we're basically arbitraging the down payment at checkout with the supplier terms. And we're collecting an additional payment or two from the customer so that when our COGS are due, for this example, we've collected, it's a little bit small, but we've collected about $375 in cash that's on our balance sheet, with the COGS being, let's say, $750 with a 25% gross margin example. And then our COGS are due on day 30 to 45. Well, we have $375 on our balance sheet. We owe $750. So the debt facility comes in and funds 90% of that $375. So in reality, for a $1,000 order, we're using about $37.50 worth of equity capital to fund it, and the debt facility takes care of the rest. Now, the debt facility is really only used, in this example, the fully loaded interest is about $11. So because we turn our portfolio about 4 times a year, it's a very effective use of debt capital to give us spread. At the end of the 6 months, we've made $250 of gross profit. If you take an average bad debt of 15%, which in the prospectus, it's actually 14.7. And as you saw the Q3 update, it was about 6.3% given Q3. We're still making $100 of net profit, which is 1,000% IRR. So we've really fundamentally structured this business to be streamlined on the operating model perspective. Our competitive advantages around how we underwrite a customer and retain them over the long term. And then we have our funding mechanism so we can use the equity capital that we've raised to acquire more customers, invest in the platform and the technology, and expand the business versus using it to fund orders. Next slide. So look, we have a really highly diverse and experienced management team as well as board. And look, I built this company. I've been an operator for 30 years. This is probably the most important thing I've done. And I used to be the chief operating officer at Zulily, which went public for like $6 billion on the New York Stock Exchange. I've been with Provide Commerce that went, public, et cetera. But here we're fundamentally mission focused. We're changing people's lives as well as building a huge business. And we really have a diverse employee base as well as a very experienced management team. From Australia, we have Sylvia Falsone that brings years of experience in finance and audit. We have our chairman, Jim Foy. I have the former CEO of FICO and actually one of the founders of FICO, the credit score in the United States, Larry Rosenberger, on my board, as well as the former deputy counsel of Google and the former president of PayPal. So we've assembled a really strong team to deliver what everybody called was an impossible mission, an impossible operating model, which is really to transform a credit challenge customer into one that actually pays you back on time every time. Next slide. This was really just out of the prospectus, and we talked a little bit about this. Again, the growth capital is going to be used to expand the business. The aspiration of management is over the next 18 to 24 months, and by 2022 to make this business profitable for full year and generating cash. We have an enormous opportunity for growth in the United States just to scale the core business. There are obviously adjacent lines of business we will explore into, which is small and medium-sized business, as well as offering differential services to our customers, as well as geographic expansion to countries in Latin America and Europe, et cetera. But our near-term focus as operators really is delivering on the forecast, growing this business to profitability, and expanding the contribution margin. I'm happy to take questions that you might have. It's a lot of information in a short time, but I appreciate your attention.
Thanks, Mark. We're actually out of time, but I think you might have gone back on mute, actually, mate. One question. You've got a long list of private equity shareholders, and how did you end up in Australia?
Yeah, so we have venture capitals. I don't mean to correct you, Tim, not private equity, but venture capital holders. Look, for the past 18 months as the CEO and the chief operating officer, my job is to bring capital into this business to make sure that it gets to its end destination. I've looked at the ASX over the last 18 months, come down to Australia twice, probably had 100 different meetings with institutional investors, and really looked at this market as a disruption market. That is very open and has been socialized to buy now, pay later through great companies like Afterpay. And I really look at it as a great destination for small and medium cap companies to get non-preference capital to grow their companies. Look, this is not a liquidity event. We're committed to this market for the long term. That's how we priced the round, to give Australian investors the same upside that we've been working on for the last 5 years. We will build our valuation through execution. But I found that, the market here is really open to e-commerce. It's open to buy now, pay later. It needs a level of, I think it likes disruptive models. And I think it's open to education on different consumer bases that might not exist here in Australia, but clearly exist around the world. And we need to innovate and capture new business models that address those big markets. Otherwise, you just get the same model coming in that just replicates itself. So I found the reception to be fantastic. I'm looking forward to a long and tenured opportunity to deliver value to Australian investors.